Hey guys, welcome back to the channel. So today we're talking about ETFs and compound interest and the power of compound interest. How far it can grow for you when your money has made more money, which can continue to make more money for you, and the power of it. Alright, so this is for entertainment purposes only. I'm not a financial advisor, so you'll have to do your own due diligence. But here we are. So last night, back to my previous video, the market for ARKW opened at $162 per share. So if you were listening to my buy recommendation, you wouldn't have purchased it. However, if you did, you probably purchased it somewhere between 162 and it got down to like 160 and 40 cents, somewhere around about there. If you're still in, you're up roughly 3%. Just from the time close for yesterday. I actually did manage to get in on Friday, so I've got an average buy price of around about 159.20, I think it was. So I'm up just over 3%, about 3.5% total. So I'll continue to watch that over the next month, and I'll probably sell that towards the end of the month, depending on where it goes to as well. Rightio, so ETFs, exchange traded funds, the advantage of them. So obviously you're only paying one brokerage fee, and what the exchange traded fund is. So exchange traded fund generally tracks like an index or a sector. You've obviously got to look into the fund itself. Normally it'll group together a whole pool of ideas and continue to track those ideas. Like let's say you buy into SPY, which tracks the S&P 500. So that tracks the top 500 listed businesses in the US, which has returned over the last, I think it's 9 years, 11% per year, compounding obviously. But I've got a whole list here of what I would suggest is probably the best ETFs to buy. I'm not telling you as a buy recommendation, just letting you know if you're not sure what ETFs to buy, because hence why you're probably watching this video. These are pretty much just the top 5 listed ETFs in my opinion, known basically. So we've got the IOO trading on the ASX, which is the top 100 global ETF. So it tracks the top 100 global businesses, which has returned over the last, I think, about 10 years, 10% per year. So there you go, so back to your 10%. I continue again on the ASX. I got IOZ, which actually tracks the ASX 200. It's a BlackRock ETF, so iShares. That has tracked 4%. When we continue down, we go VAS, which is a Vanguard fund, which tracks the ASX 300. It's also tracked 4% per year. IVV, which is an ASX listed fund that tracks the S&P 500. Now, I think that one's over 9 years again, which has tracked 15% per annum. And then obviously we're back to SPY, which has returned 11% per annum. Rightio, so compound interest, and it's something that if you're still on the fence about not quite fully understanding how it works, pretty much just think of it like this. You invest into something which has made more money, and that money that made you more money is continuing to make more money. So it's like building back on itself. So it's called compound interest. And basically it will continue to grow further and further and exponential through growth. So for instance, let's say you had an average return of 10% over 40 years, and you were going to contribute $50 per week. $50 per week is not really that much in the overall scheme of things. So you would have contributed over 40 years, $96,000, which would equate to $1.1 million. So, like, if you talk your super, I'm sure your super wouldn't have grown that much over that period. Now, and that's because you get super fees and everything else that's involved in it. Now, if you wanted to tone it down a little bit, so obviously if you were to jump down to say $25 a week, you would have contributed $48,000, and you'd have a return of $555,000, so $500,000 in 40 years from $25 a week. But let's say if you were to go a little bit harder, which is what I would say is a little bit more realistic in the scheme of things of where you should be going with it. So let's say if you were to do say $100 or $150 a week, say if you were to do $100 a week over 10 years, you would have contributed $48,000. This is only 10 years, not 40 years. So you'd have contributed $48,000, and you'd have a return of $79,000 over 10 years. So it's a pretty easy way to save up for a house deposit in terms of that side of things as well. If you were to make it, $150 a week over 10 years, you contributed $72,000 a year, so over the period, and you would have a return of $119,000. And in most cases, that's more than 20% as a deposit for a house. And to be honest, like if you started working when you're 19 or 20, most people start younger than that. By the time you're 30, you should have roughly $100,000 as a deposit, which hasn't really cost you that much in the overall scheme of everything, where your wage is coming from. Obviously, when you're 19, 17, whatever it is, it might be a little bit of a stretch to get it to $150 a week. But as your wage increases, you'll find it much, much easier to be able to get it there. And that's obviously the advantage of compound interest. The sooner you can get in, the more chances it has to grow over a longer period of time. Like if you were to leave it for even longer, it would grow exponential from there. Righto guys, so that was a quick one. I obviously will be back later on in the week to see how ARK W has gone as the investment continues. And yeah, please like and subscribe to the channel. Comment below if you've got any questions, or if you've got any recommendations that you want me to do an analysis on. I do have another buy recommendation coming out towards the end of this week, so please continue to watch that one. That will be listed on the US exchange as well. So if you wanted to work out how to get there, use the link below for stake. If you contribute to it, you will receive one free stock. I will receive one free stock as well, and that stock, could be worth up to $140, I think, from memory. Yeah, so hop on board. Okay, cheers guys, see ya.